and I signed my first COVID-19 disclosure document by car. I went, you wonder how disclosures all show up, right? Hey, Daniel.
Hey, good morning.
How are you, dude?
I'm doing well. How are you?
You know, living the dream, baby.
Put a nice sweater
Another
on.
crisis.
Put a nice little sweater on after today's call, I see.
Yeah, I mean, took a shower, shaved. Don't want to look old.
Awesome. Awesome. We'll give it a couple minutes to let people jump on, and then we'll get started. Thanks again for being on the call with us today.
You still flying a bit?
Yeah, a little bit. It's not good for the engine to just stay idle like that for a long period of time. Yeah. So I try to get up here and there when I can. But yeah, went up to Kern Valley this past weekend. It was really pretty up there. Nobody was up there. Yeah. All right, got 40 people on. Give it another couple minutes. I got a little theme song for us this morning since we all are probably on 100 million different Zoom calls. So I got a little theme song to start the call today. How many Zoom calls you on a day, Bill?
Oh, by 10:30, I've had about 5.
10:30 a.m. I take it.
Yeah. Now it heats up. We're East Coast driven, right? Markets, and then so we do all of those early on, mostly hedging and what pricing is going to be, and what product are we going to cut off today. What investor are we going to cut off, or who we get a call from late last night. So it's pretty amazing, actually.
Yeah, awesome. I see Courtney's on the call. Good morning. How you doing? Awesome. Ron, you kicking back in the couch there too? Looking good. You in Palm Springs still?
Same place, same time. Yes, sir.
Awesome. Awesome.
Yeah.
Morning, Gino.
I'm looking forward to getting home, Daniel. I really am. So
I bet. I think everybody here is looking for.
Good morning.
Good morning, everyone. Glad to be here, Daniel.
Hey, good morning, Don. Good morning. Scott Brown. Good morning. Raina. Good morning.
Hey, Don.
Mr. Winnicky.
Chris.
Hey, Marissa, Joelle, Nicole.
Hey, Uncle Bill. It's what, our third call already today, I think, together.
Bill, Scott, what are you holding up there? Is that a thumbs up?
Check the Facebook logo. I like it.
Looks like we got Linda Whittlesey, our speaker from last week, on the call as well. So maybe,
hey, Linda.
Any questions for Linda? We might be able to get them in there for her. All right, give it another 30 seconds. Looks like we're up to almost 70 people here, and then we'll get started. The call is being recorded, Bill, so...
Uh-oh. Better tone down the F-bombs.
That's open a can of worms. Do we do the over and under for F-bombs?
No, this will be PG-13.
All right. Awesome. So quick reminder, guys, if you don't mind muting your lines while the presentation's going on, and obviously any comments, questions towards the end, don't forget to unmute your line if you're going to be speaking. We're going to start off with Bill this morning, and then towards the end of the call, we are going to open it up to all agents, and we've got a couple of questions that have come in prior to today's call that I think a lot of people are interested in hearing from one another. Particularly, if anybody's listed a property in the last 7 days, what has the feedback been? What's the activity level like? We're hearing stories of, multiple offers still, and even in today's environment. So we'll open it up for an open dialogue and open discussion towards the end of the call. So with that, we will get started. Thank you everybody for being on the call today for our second all agent virtual roundtable brought to you by the WeFund LA team. We've got Leslie, Joanne, Evan, and all of the WeFund LA team on today's call. Today's guest speaker is our very own Bill Dallas, who's the president and CEO of Finance of America. Many of you are familiar with many of our past brands. We branded under Skyline, we branded under the Madison Lending Group, and Bill has been our leader through all of those transitions. And he was a big supporter of helping us launch WeFund LA, which hopefully that's it, we're done. It's gonna be WeFund LA forever until I retire from mortgage. Bill's responsible for inspiring and leading a dozen different mortgage, banking, and fintech companies over the last 40 years. He also founded and serves as the chairman of the and board of directors of Oaks Christian School in Thousand Oaks. And so, Bill, thank you for being with us this morning. How are you doing? How's your family doing?
Doing good. Here, come here for a second.
What?
Here. This is my only family at home right now. To 5 kids, my wife. Hi everybody.
Hey, Bev.
I am learning so much about everything in mortgage.
I'm having to keep it down, but yes, it's like, so I am more reserved a little bit for about 2 minutes, and then it takes off. But no, thank you. All my kids, 5 kids, they're all over the place. Everybody's safe. I hope all your families and friends are safe. I only have one living with somebody who is actually contagious. So I've got one quarantined with one of our top LOs in Minnesota. So blessings to everybody.
Awesome. Thank you again for being with us, and hoping that Jake has a speedy recovery.
Yeah, no lie.
Yeah. So let's get into it. We've seen a tremendous amount of disruption in the mortgage industry, and obviously in real estate as well. We've seen, the suspension of many products. We've seen rates on a wild roller coaster. We've seen some lenders even just close their doors. It feels eerily similar to the financial crisis of 2008. Give us a 10,000-foot level overview of where the mortgage industry is today, Bill.
Yeah, I speak for everyone when I state that things are really changing at such a rapid pace that even my perspective this morning will change by probably noon, if not by the hour, by the moment. But I've, like many of you, we've lived through a lot of these. This is probably similar to a recession plus what I would say a quick recession plus what I would call the global financial crisis that we saw in 2008. It has the combined that way. So it's really with those shifts. I think what you're seeing in lending is a very quick vacuum of lenders and products and investors, right? And so that happened almost immediately, which is unheard of. Jump from jumbo to non-QM to anything that was agency, that was not agency, it almost went away almost immediately. So when you look back, that happened quickly in the financial crisis of 2008, although it probably took 2 years. And then we settled back into full agency delivery, which is somewhat where we are today. So when you look at lending right now, it's gone to pure vanilla pretty quickly. And so the questions then become of what can I get done and all of that. We've never seen things like VVOEs and PIWs for appraisal waivers and the like, right? So that's all brand new to us. And I think ultimately for each of you, right, the shift in how consumers and businesses are changing as a result of it is really interesting. But I think overall, the lending market, we're sort of over the first wave of what I call the liquidity crunch, cash crunch for many, where you just had margin calls. I mean, I told our group that we had close to, in 1 week, I had $90 million in margin calls. And that was just moving cash from one pocket to the other and praying that that's something that tomorrow wasn't another 90 million, right? And so I think that was your first wave, and then you sort of moved into the products going away. Then you moved into warehouse banks, and our bank partners requiring much more cash in every deal. And then you move to really hedge costs, just going like this. Really, the product that you all have been affected with the most, and I think most of my California originators have been affected the most, is really conforming high val, right? The product that sort of fits as a tweener between jumbo and conforming. That product has sort of gone back to the 10% tolerance range and really got crushed. Those spreads widened a lot during this period. And then the final blow was really where we sit right now, which is servicing. We could talk a ton about forbearance, what the consumer's doing, what you tell the consumer, what the consumer thinks. But at the end of the day, I'll give you a good example. I was on a call with Jay Bray, who is the CEO of, and every day I tell these guys, I text 17 CEOs, and we have sort of our own little group where we're just sharing what's happened. I've actually been on Zoom calls with the team at Movement. I've been on Zoom calls with the team from Guaranteed Rate. I've talked at length to Mr. Cooper, and the most interesting fact yesterday was asked how many forbearance requests had we received at FAM. And so I asked Jay Bray, I said, how many have you received at Mr. Cooper? He said 86,000. And we have 19. That's the bid and the ask between, I think, how monumental the ask is by consumers. So I think now we're moving into the next phase, which is, okay, how do we close all those loans that we locked really way too long in January and February? And how do we then move out of that stage as we get returned back to normal, as the MBS market and TBAs, these to be announced coupons, narrow back to somewhat of a normal pricing grid. But that's,
Yeah, and we'll
at
get into
30,000 feet.
Yeah, we'll get into forbearance here in a bit, because I think it is mission critical. There is an important message that needs to be delivered regarding forbearance. There's so much information that's come out about it. And I think there are more questions and answers at this point, but we'll get into that in a minute. I did want to go back to your opinion and your perspective of, once we get back to some sort of normalcy, whether that takes a month or it takes a quarter or 2 quarters, how quickly do you suspect, or do you expect that there's going to be a return of, more aggressive jumbo products? We've seen, basically the complete suspension of the non-traditional mortgage market, right? Bank statement and P&L loans and asset depletion loans that many of the agents on this call relied on to put people in homes and to get people into escrow. And we've seen basically complete suspension for the most part on a lot of those products. How soon after, we get back to some sort of normalcy, do you see those products coming back into the market, or do you think that's a year or 2 away at best?
Well, it's a good question. And I've been here before where you've seen it. I think it's a little bit like probably a home improvement, where you get a bid and they say you're going to do it in like 2 weeks and it takes like 2 months. I think it's going to be longer than we probably think it is. But I would think that the infrastructure is so built for it that if you don't get back to normalcy in some facet of that market pretty quickly, you're going to see some real devastation in the lending market. Lenders falling apart. I mean, you've already seen anybody who's niche-y, who just did jumbo or did non-QM, that group is basically washed out already. So, but my view would be that the market, moves immediately when you go through these periods, moves immediately to plain vanilla. And I think we will go back to what I'm going to call, Neapolitan or 3 flavors pretty quickly, where you will see people come back, and the first to return will be a jumbo, which I would think high val will get better, right? That'll be good. You'll get a jumbo investors and a super prime price, type, more like a Wells Fargo or a Chase or one of those products as you go through. And then finally, I think the lagger will be anything non-QM. And it'll go in that order, right? As it comes back. Expect it probably not in, I don't think you'll see anything in what I'm going to call Q2, which is what we be in now. This is going to be the funding ourselves out of business quarter for everybody. We just need to get the funding and make sure that those loans fund. And that challenge is going to be verifications of employment, valuations, and is the customer still alive, and have they not already availed themselves on some sort of forbearance? So I think you can expect it in Q3. You'll see mini bloom where this will start to happen. In Q4, you should be back to normal.
Yeah.
I mean, normal being that I'm going to call this will be what we're going to call the new abnormal,
Sure.
because it isn't going to be normal for a while.
Yeah. On last week's call, we touched a little bit about this extra layer of verification or underwriting that we now have to do, right? We would normally go through income, credit, assets, and check all the boxes. And now we're having to ask, have you been impacted by COVID? What line of work are you in? What industry are you in? Are you in production? Are you in post-production, pre-production? Are you still working? Was your show put on hiatus? And so, I think it's important for all of our agent partners and everybody on the call to know that it's an additional layer that we now have to check into. And unfortunately, there are many industries that have been impacted. There are very few that haven't. And we are responsible for making sure we're doing loans for people who can afford them, who haven't been impacted. And honestly, I think we're looking at post-close reserves and liquidity as one of the key compensating factors. I think we've had very similar borrowers that look the same, that are in the same industry, but it really came down to the overall strength of the borrower. And is it likely that borrower A will ask for forbearance in the next 3 to 6 months because they have maybe 12 months of their payments in reserve? The other borrower who's in the same line of work, who has the same credit score, but doesn't have very much in post-closing liquidity. What are you seeing, Bill? Do you see any of those guidelines potentially loosening up at all, or is this the new normal for?
Well, so it's a good point, right? So all of us, raise your hand if you came out of 2008, right? With all of me, right? We were all there. So what do we have? We needed 2 investors for any one loan, just to be safe, right? If you could find one, and if you could get 360 months reserves, right? You got it, right? Because we created 0 default for that period, for that initial period of time. It won't be that tight, right? But it is going to be tighter than it was, right? So I think what you're going to see, and so what we did at PAM was we had to go back and reassess how do we, and I guess maybe what you would ask would be, how are you going to handle, I mean, we have 200 underwriters, right? All over the place. So how are we going to build a grid of what the new box looks like? And then in that box, how do I give flexibility, what you guys would call, what the industry calls compensating factors? How do we give compensating factors to a group so that they can use their own discretion and make these loans for you, right? So everything's not an exception, which is what non-QM was and what it was like back in 2008. So we already have those things built, which I think will be helpful to you. And I think, but the move would be, you'll see an increase in this, what we call this. I told our lawyers to dumb it down on our attestation. We wanted to the industry wants to put a whole new disclosure, much like cars put out on COVID, that you would have to sign and attest to. Scares the shit out of you. If for most of you have been doing it a while, it would be like the 4506T when it first came out, right? When everybody was committing fraud on income, let's go to get a verification from the federal government. You have to sign an attestation that this income is yours, and if you violate it, you go to prison, right? And then we put that back in the application. What you're going to see from us, and I think from most lenders, is an attestation which basically adds, I'm employed, I'm currently employed, I expect to be employed, right? I was really unaffected by COVID, and you can rely on my income. And I think you'll see that way up front. It's going to be more in the LE, right? Or more in the app process versus showing up on the back end and the disclosure part so that the customer sees it quicker, right? But verifying it, we have got very little, what I would say, guidance from the agencies on how to do it. So we're just doing it ourselves. And I think the advantage for Finance of America, the biggest advantage is that we had no, and I did this purposely, didn't want to retain MSRs or retain servicing because I didn't trust it. But now it's a huge opportunity for us to do it. Values are really low. We're not hit by this COVID. We don't have all these borrowers calling us. So we are now gonna, it's like in trading places, right? Where we're selling oranges and now we're buying oranges. Well, now I'm gonna start buying oranges. That's gonna be a big advantage to Finance of America because we can underwrite our own stuff,
Awesome.
right?
Thank you for that, Bill. We have a question. I know that Daniel talked and touched upon the post-close liquidity, the reserve requirements for people applying for mortgages now, looking to buy even now through COVID-19. But to take it a little bit back to forbearance, we've received so much information regarding the CARES Act and what it means to struggling borrowers who are experiencing legitimate hardship. As an industry, I mean, we know it's important to convey the right message to our clients. What would be that message from you for clients?
Yeah, so great question. You can, and so for our Finance of America advisors, right? Here's what I recommend. If you are affected and you've lost your job, say COVID and forbear, right? If you've lost your job, right? And that would be, and so of the 19 people that have availed themselves on us so far, we just immediately forbear them, put them into a program. And then I would move to the next ladder, which is if you are a borrower, right, and you have not lost your job, right, not been laid off, this is not for you. The program isn't designed that you could just call people and say COVID and then we forbear, because this will put I think a really undue hardship on that borrower, because the catch-up period is either, if you choose 3 months, 6 months, or 12 months, which I think are your options right now, you're going to have to catch that up really fast, or it's going to be a lien against you. And I don't think that borrower will be able to borrow going forward at all until they clean that up. Now, for sure, you can promise the borrower that if you forbear, we're not going to charge them interest, we're not going to charge them a late charge, and we're not going to report them to credit bureaus as if they're delinquent. That doesn't mean that once they've gone into the forbearance or whatever the delay program is or the modification, and they start missing payments again, right? That doesn't mean they go into default and then they're reported. So that would be my message.
Bill,
Right? So succinctly, make your payment if you want to get a loan in the next couple of years, ever. And if you are affected, God bless you. Let's see if we can help you, right, somehow.
Bill, so you said, if you lost your job, ask for it. But what if you lost your job and you were a responsible borrower and have, $100,000 in your savings?
Yeah. So Juice, I was just talking to Juice a few minutes ago because Jake's in with Juice. It's sort of funny, Jake and Juice. It's pretty good. But he said, okay, I have this borrower. He's a contractor. Just went from a 30-year to a 15-year loan, right? Names remain. So he's got $500,000 in the bank, but he's a contractor and he's a little worried, so he wants to delay. It's not for him. Right. So I said, Juice says, what do I tell him? I said, you tell him to make his payment. Right. He's got plenty of money. He's going to work. It's going to be a delay and it's going to be a little bit of a hardship, but isn't, forbearance is not forgiveness. And I think everybody thinks they've read about they've read about other loan products. And even in California, right, the governor came out, he cut a deal with the 4 big banks, and the banks basically said, we're going to delay certain payments. Well, these are car payments, student loan payments, other things. These aren't mortgage loans, right, with these folks. So I think the messaging, you guys could be really integral in how you help people, right? And I think for us, it's important that we all relay the same message.
Hey, so I have a question. I got a call from a client who was in the pre-approval phase last week, does not own a home, but owns a small business. And he said, hey, Daniel, I want to take out that $10,000 small business grant that they're giving away. Will that affect my ability to get a mortgage? And this guy happens to own a small media content company. You know, he writes content for a couple of websites. And I said, do you need the money to continue paying your employees? Do you need the money because you have a genuine hardship? He said, no, I'm flush with cash. I'm good, you know, but it's like a free $10,000. You know, should I take it? Should I just grab it? Maybe I can use that to pay some of my closing costs. You know, that call really irked me because unfortunately, I think, you know, people will take advantage of the situation. And, you know, I told the borrower that, you know, in very, very nice terms, that an underwriter could view him obtaining that grant as his business being on shaky ground. And I encouraged him not to take it because very likely it would mean he cannot.
It's very, I mean, look, I see it too. All the accountants, all the financial planners, everybody starts jockeying for position on how they can commit fraud to get the money. I've heard from so many borrowers and people trying to game the system and folks who own businesses. And then I do, like you said, I think what irks you is then, you know, I know one of my best friends owns a business that basically is the outsourced service provider for restaurants. Well, can you imagine a worse business? Right now, there's no restaurants, there's no outsourced servicing, and everybody's going on furlough or everybody's going away. So he needs to apply and get in line. And everybody's sort of jockeying to try to be first in line, like the money's going to run out. Well, if it runs out, they'll apportion more money for it. Now, the other thing is, from an underwriting standpoint, I thought maybe where you were going is, I think I can probably use that income to qualify if the business starts back up again. So that person doesn't have interruptus, right?
Interesting.
Right. And if you borrow, because you can take your payroll, right? The PPP program's different than the asset program. So you could basically take your payroll and have that being paid, so we could use that income in the interim, right?
So I think the message is do the right thing. You know, when I was at the Reserve Academy, going through the Sheriff's Reserve Academy, someone defined integrity as doing the right thing when nobody is looking. And
Yeah, when you're
gives the ability to people for you know, the consumer, for borrowers to stay in the shadows and maybe, you know, take out a loan when nobody really knows about it. But I think for the consumer that's trying to obtain a mortgage or potentially get financing in the future, whether it's a car loan, a mortgage loan, it could cause issues for that person. And so I guess the message is do the right thing always.
Yeah, now let me add one more, right? I would say there's one new term, right? First pay forbearance. We've never seen a first payment forbearance, right? We've had first pay default, we've had EPDs, we've had FPDs, but a first pay forbearance is killer for mortgage companies and for us, right? We do a loan, you do all the best you can to verify, right? We close the loan. You do all those extra VVOE bullshit things, and you do all the other stuff that you got to do. All that's pristine. We fund, I'm going to use my first F, we fund the little fucker somehow, right? And it closes. So we got this little thing now in the pen, right? It's sitting in the pen, and now we have to deliver the loan to the investor. And lo and behold, what's the little sucker do? Files for
Forbearance.
first pay forbearance. So now that loan is now what do we have to do? What did you I have to forbear. So before the loan, so the risk for us as mortgage companies is as the loan is sitting in warehouse, before it is delivered to the investor and before it is purchased by an investor, right? That loan is unsaleable and repurchasable. And so for all these companies that are going to sell their loans to Wells Fargo or PennyMac or AmeriHome and sell the servicing, they got a lot of problems because they're going to repurchase probably a large portion of those loans because forbearance is going to continue for at least, how long are we going to be in this? 30, 60, 90 days, 120, I mean, who knows, right? But so that's one of the other reasons why we're retaining our own servicing. So we have more control of that.
Awesome. Hey, two more quick questions. You're kind of a disruptor yourself. You created CloudVerga, which is a fintech company that really streamlines the process of obtaining a mortgage in today's high-tech world. And I'd like to get your thoughts. I mean, breaking news this morning: Redfin laying off 40% of their staff.
Yeah.
Zillow, Opendoor, all of these big tech disruptors are retreating. Is this the time for the incumbents, for all of the agents on this call, to reclaim their industry? What happens to some of these big tech firms, post-COVID?
Yeah, I mean, great question. I mean, I think I'll take to CV. So the first thing I did at CV was applied for a PPP loan.
CV is CloudVerga.
CloudVerga, right? So we applied, we fit, we have personnel. So we're, a Series C, Series D startup. So we've raised a bunch of money, but so we could avail ourselves on it. And so we gave that our first shot. I think what I've learned about crisis or this change is it accelerates the model to change, right? And this is true in every crisis. So one of the most difficult things about building the platform is that the complexity of all these products make it very hard to automate them all, right? Well, suddenly what's happened? We have like one product, one investor, the federal government, it's a 30-year loan. So it makes it much easier to streamline and to go forward. So what have you guys already seen? We've seen e-close, hybrid e-close, remote notary. You've gone through all of those processes. We're even thinking of just moving totally, even though we're a dry state in funding, to move wet, right? So we have more control of the LE and the CD so we can close faster. But all of that's just the beginning part of the game. When we retain those assets and we can improve pricing and deliver direct to the agencies, this means that the platform that we built could actually go on steroids and be used the way it was intended, which is to use day one certainty, appraisal income waivers. Know those up front. I think what you all will come out of this with is you'll be able to immediately assess a customer, and we're going to create a streamlined customer for 65-70% of our customers where we're going to need much less information. And I think that's going to be the biggest innovation coming out of this, right? That we can make decisions. And the only reason we gather all that bullshit to try to make an income decision is because the investor is so esoteric. The non-QM investors, there's very few of them. Non-jumbo, there were very few. But when you look at the agency business, we can probably change. That's a game changer from a documentation standpoint and requirement standpoint. So I think where you were going before is we had added all that documentation back into a file, hadn't we? You looked at files in 2007 and 8, they were this big. And you look at files today, they're this big, right? Hell, half the things are just disclosures, right, that are in there. And I think what you're going to see is us go back because we'll be able to integrate those technologies.
Got it. Your thoughts on some of these other disruptors that you see retreating in times of crisis, Redfin, Zillow, Opendoor.
Oh, those guys, I mean, it's hard to disrupt your standard realtor, right? Compass or your friend in an agency, or you look at big time realtors who do a really good job at it. I think I think probably I actually would think that if they could take the disruption, they're in a better position now than they were, but they just probably won't survive because they don't have enough cash. Because their business model is basically lose money and make it up by raising capital. I don't think they'll be able to sustain themselves. And realtors, the real estate business is going to suffer. And so only the strong will survive it over these next few months. And if you do, I mean, that's the quote that Eugenio sent it out to me again, and I basically changed mine. Jamie Dimons, you know, what he said yesterday, which is entering a crisis is not the time to figure out what you want to be, right? What do you have to do? You got to mobilize your resources, take your losses, and survive for another day. But when you have capital and size, you can do that. When you're a startup, you are fucking hosed, right? You got to, because you have no money, none. That's two.
Leave our agents and our partners with some advice. What should their focus be on? You know, I know a lot of people are spending time at home. Some are using that time to, you know, do some training courses, to master the RPA, to work on their marketing strategies. If you're a realtor in today's environment, Bill, what is your advice to our agent
I
partners?
go a little bit to Duncan's thing. You know, I'm going to say fast, fit, right? And then I think family. I think the only way to survive these things is to reach out and help other people, right? As much as you want to do, you know, you can all, you got plenty of time to read. I mean, like my wife and I are trying, my dad was a music teacher. I bet you didn't know that. And my mom was a coach. So I had, my mother was the male figure and my father was the female figure. That may explain a lot, right? But at the end of the day, what we're doing is we got a piano, and I'm going back to figuring out, you know, to be able to play the piano at all. So yeah, I think you've got to do something. I binge watched last night Homeland, which I hadn't seen in a while. So you do some really stupid things, and I think you've got to improve yourself. But I think you got to stay fit. You got to focus on your family and your friends, right? And then help people. Help everybody. Reach out. Now, social distancing and all that other stuff, you know, yeah, you got to do that, but it doesn't mean reach out to people. I try to reach out to every other business. I mean, like Casey Crawford and I are close friends. I don't know if you were, I mean, I'm a Christian, so on Sunday we basically went on Facebook and they had my movement, and so we joined. A lot of us joined in with the movement crowd for our Sunday service, right? Palm Sunday. So it was, and yet at the same time, I probably talked to Casey twice a week, and his team basically said, "Can we just have a call with you?" Just their COO, and what do they want to know? Same thing you want to know. What's going to happen next? I think you guys could rest assured to know, you know, we're designed for this. I've been there before. We've got, for Finance of America, we got plenty of capital, right? We will make it through all of this. And at the end of the day, I think there'll be a lot of innovations and things that will come out of it for companies that can survive and help people. I think the number one thing we're trying to do with each of you is the same thing that you're doing right here, right? We're trying to stay communal, make sure we understand relationships are important, and then spend time with our people every day.
I think today's environment, it's counterintuitive because the last thing we should all be thinking about is a commission. And today, all of our activities, many of our activities come with zero commission. And I think our focus today should be on serving others, providing information, being a resource, and knowing and accepting that today that means no commission. But it's through the times of hardship, it's through the difficult times that I think our consumers, our borrowers, our clients, our partners remember who was by their side during the difficult times, not only just during the good times. And so with that, Bill, thank you very much for being on today's call. We really appreciate you taking time and being with us today.
No, many blessings to all of you all, and thank you for all you do for us. Let's go out and help some people.
Awesome. Thanks, BD.
All right. See you guys.
Awesome. We're going to transition to some real estate focused stuff, guys, because I think it's important to give you guys all kind of a platform and open it up for some dialogue on what's going on. And last week, a few of you shared some real life experiences, what you're seeing, what you're experiencing. And so I wanted to do that again today. Obviously, you're all an essential service now, but really limited in your scope and what you can and cannot do. So I did want to hear from maybe somebody who has listed a home in the last week, who put something new on the MLS in the last week, and give us an update on activity, is the phone ringing? Anybody have some success stories? I know a couple of you on the call have listed stuff in the last 7 days, and I'd like to kind of get just some feedback on what you guys are seeing. Feel free to unmute. Chris Reisbeck, you just sent me a message. Go ahead and unmute.
Hey guys, yeah, so I listed a property, kind of your bread and butter, as Gus likes to call it, in the 500,000 range. Had a ton of listed it Friday night. Had a ton of showings over the weekend. I had all the buyers.
Let me stop you there. Let me stop you there. What do you mean showings? Can you give us specifics on how you conducted those? What did that look like?
Sure. Yeah, so I just put in the agent remarks, please call me for showing instructions and to, whatever that means. So I had some folks want to do like a virtual Zoom or FaceTime call. And then other buyers that were very aggressive about it and wanting to see it in person. If that was the case, then I made sure to send them all the PEAD CAR form. And without hesitation, all the buyers signed it. As well as the agents, I let them know that I need to have that back before I confirmed an appointment. I thought it would definitely put some people off, but they were happy to sign it. Got it back, confirmed appointments. I would probably say I had about 13 showings between Saturday and Sunday, individual. And everybody was very cool, cordial, orderly, would go through the house, one at a time, one party at a time. I kind of stood outside or in the backyard and consulted with them as they walked through, then let the next folks through. Now I have 3 offers on it. And they, I've notified them all that, they all need to check and get double qualified with my lender.
With the Bank of America?
Can you confirm who that is?
Yes, it is. Just make sure that, they can definitely qualify for the loan. And so far things are checking out. And
Chris, walk us through the conversation with your seller. Why list? What was that conversation like? Is there a life event that required them to put their property on the market today? Or was it, walk us through that conversation.
Their situation was a little different in that they're getting divorced. So they really had to. We've been prepping for this for a while, and this just happened to come up. And so I just made it very clear to both sides. I said, are you sure you really want to do this? I wasn't really sure. I'm like, are we going to lose some buyers right now? This is kind of a price range that I think that buyers are going to have money in hand. I think some higher end luxury buyers might have had some money in the stock market, but it's kind of my belief that, people in that million range and below may have their money more in savings or something like that, already kind of cashed out or, not even in the stock market. So, I kind of explained that to them. I was also very upfront with them, letting them know that if we did get offers that, we had to make sure that everybody was really well qualified. We might get people down the road that once we do accept an offer, that might beat us down and take advantage of the situation that's going on right now, and ask for a larger credit or maybe a reduction in price. So we need to be prepared for that. They were fully understanding of that at this moment, at least. And we'll just kind of see what happens from that. But I was, I did even say, how do you feel comfortable with people coming through your house? And they seemed cool.
Chris, I mean, congratulations. You hit on a few very important points that I think are very informative and useful for our people on the call today.
Yes.
You're in a very, what I'll call a low risk category, right? People, buying a house in the 5 to 700,000 range are likely going to obtain conventional financing, where we haven't seen that much of a disruption. Once you get into the jumbo territory, you made a very, very astute observation that people buying in the $1 million plus, $2 million plus category likely have their investments in stocks, bonds, mutual funds, and we've obviously seen a ton of volatility there. So congratulations for being a very, very wise, smart agent and for guiding your borrower, your client through these tough times.
Thanks.
Carla, I think you also recently listed something. If you wouldn't mind walking us through kind of what you've seen and tell us a little bit about your new
Sure.
listing.
Sure. I had a listing that came on the market on Friday morning. It's 1.25. I have had several showings. I haven't done any showings myself to my own buyers. So I have walked through all the agents through basically the safest way to go ahead and do the process. So I book showings at least an hour or an hour and a half spread in between. I have advised all the agents to have the new card form signed by their clients, to wear gloves, to wear booties, and to dispose of them or to take their shoes off when they come in. I also have 3 rooms in the home. So the bathrooms and the laundry room, the lights are already on sensor, so there's no need to touch that. The property is a complete remodel. No one has lived in it. It's vacant and it's staged. And so that helps a lot because there's no one that actually resides in the property. It looks like I have an offer coming in today, a West Side agent that's telling me that their clients are very interested. I've also had the discussion with the agents as to, where the client stands with their financing. Out of all the showings that I've had, the agents are telling me that the buyers are putting at least 50% down. So, we'll see where it goes. I'm also representing a cash 1031 exchange buyer, and we only have 11 more days to get a property in escrow. And so I will be doing a showing on the West Side this Friday as well. I've also offered all the agents, that I'm totally willing to do a virtual walkthrough with them. 2 of the agents are actually, their clients are not even local. So they went through on their own to do video for their clients who are willing to purchase in this manner.
Thank you for sharing, Carla. If anybody has questions, feel free to unmute and ask your question. Sherry, Curtis, you're on the call. You're in the middle of an escrow or two. I'm going to unmute your line. Would you mind just kind of walking us through how has your escrow been going? How your buyers feeling? You're on the buying side on that transaction. Sherry Curtis? Sherry? Maybe not. Hey, you there?
For this particular escrow that I'm in, it's
Sherry.
amazing. Can you hear me?
Yes, go ahead.
Okay, perfect. I don't know if anyone else has experienced this, but some of my buyers, when the stock market plummeted, they lost their deposits, a big portion of their deposits. So I wasn't really sure how we were going to make some of this stuff work. But it ended up working out, and I actually wrote amazing letters to sellers to be like, my clients are still confident and really want this house during this time of uncertainty, to kind of be like, just take it, But I mean, for me, it's been pretty smooth sailing. We have a couple listings as well. And those, very quickly, one of them, we didn't have an open house. It was listed for one day. It's like a two house, and got 3 offers within 48 hours. Went a couple hundred, over asking. So, I mean, for us, it's, obviously the meeting with clients and putting new listings together and prepping them, we've got some stuff going on, and it's a little slower, and buyers are a little more reluctant to want to see things. I've been, masking and gloving and seeing stuff with people who really, really want to see it. But my experience has actually been pretty positive. to be honest with you. You know, the escrow that I'm in right now with you, Daniel, I mean, my buyers call me and they're like, are we doing something wrong? Because it's been so smooth that they're like, are we missing something? I'm like, no, everything's good.
Okay, that
So,
wasn't
guys
planned.
so much.
That was not planned, by the way. Everybody.
No, it's true. Like, I have to just call and check in with them just so that, like, just to be like, yep, everything's still good. A few days later, yep, everything's on
That's
target.
good.
And, you know, we received an
Joey,
email yesterday that we get to close even a few days early, which we were only on a 25-day escrow. And so now we're going to close, you know, a few days early. So
yeah, thank you for that. Bill had a question for the group. How is everyone dealing with offers, contingencies for financing, appraisals? Are we moving? Are we seeing the request for longer closes, drive-by appraisals? Anybody care to comment on that? Please, not all 67 of you at the same time, one at a time, please.
I could make comment to that.
Please.
I just, going back to this particular sale that I just mentioned, I did, let my sellers know that traditionally we want to be more aggressive. We want to reduce our contingency times. And, right now we're going to have to, out of respect for the current market and the situations going on, probably leave loan contingency to 17 or 21 days and make sure that we can get it closed. We've kind of been talking and having a discussion here in our office that, even if we were to remove contingencies and move forward and we get a couple of days towards the end of closing, that if the buyer did have to back out because they got sick or they lost their job because of this, if going to arbitration, is the buyer really going to get their deposit back? They're going to kind of look like a jerk if, they're not open to work with the current market situation. So
Would you, I was thinking of when I used to do it, I started in real estate. I trained my only other job was training realtors nationwide for Better Homes and Gardens. So I was a director of training, and that's how I cut my teeth into business. Would you recommend or are you like in that situation, did you accept backup and perfect that backup, or did those people just go away? Because I would think right now, just to cover yourself, maybe a person, I know people don't like to be the backup for whatever reason, right? They just don't like the strategy, but what are you doing?
yeah, definitely get someone in backup position, keep them posted, keep them cool. I would think, I generally try to do that anyways. But I think even more so right now, just get them lined up and still kind of communicate with them. And, you don't want them to kind of drop off and tick them off and have them move on. And, got to protect my seller at the end of the day. And it's not done till it's done, especially in today's market.
Yeah.
And if I can add, Daniel, if you're representing a buyer right now, I mean, the COVID addendum really provides you with a lot of protection for your buyers, including extending for 30 days, cancellation, even after you remove your contingencies, should you lose your job or something directly related to COVID. So I don't think I'd write an offer right now without that addendum in place. And having said that, has anybody got any pushback on that addendum from their sellers when reviewing offers?
Can we be helpful in any way to make? I mean, one of the things that's happening is that shorter lock. I mean, you know how buyers are, right? Or people, when do I lock? Do I play the market? What do I do with it? Well, obviously, right now, the closer you're going to get to closing, in my view, this is again just personal view, your pricing is going to get better because shorter locks are going to be priced better just because of the high volatility in the market. So versus protection of trying to get it. So I don't know how I would do it because I also don't like my customers to float, right? If you like the rate, take the rate, be done with it, apply. We had a product called Lock and Really Live and I think maybe, we should consider how we roll that back to make, because I think shorter term is going to be so much better priced right now.
Just to kind of piggyback off of that, Bill, a couple of things that I've seen with the agents that I work with and the clients that obviously I'm representing on the lending side. We've kept longer contingencies in place, but we've been able to close the loan before the contingencies are even up, right? So 17-day appraisal, 21-day loan to protect our buyers and keep that in place as long as possible. But I closed that loan in 16 days. So, you know, we were able to move along pretty quickly, which keeps a seller very happy, right? On the other end, it reassures the seller that the buyer is performing, and obviously they're getting updates that the docs are out, all of that. But keeping longer contingencies in place, but you know, obviously, you know, we have the right processes in place to move a little faster. So it's kept both parties kind of protected at the same time. The seller gets, again, that reassurance that we're moving quickly and moving through the escrow, but the buyer is still protected with standard contingencies.
Yeah, we're starting to think of ways too, you know, because the appraisal, like we own an AMC, we also own Boston Title. So we're trying to figure out ways, are there ways that we could integrate things that make it simpler and easier, especially with all the disruption. But I think that's a good point, Leslie, that when you take we made an offer on a house in Minnesota, and then my daughter bought one in Minnesota during this period, and we did the exact same thing. We were concerned, how do you make a strong offer, still give yourself plenty of time to close, right? Just in case, right? There's appraiser can't get in or you can't do something. So I think those are all interesting. I'm going to take back to our group, how do we help you with being able to lock and shop, lock and drop, something that allows you to take advantage of it, yet still be covered on the top end without the hedge costs costing me a fortune, right? From the mortgage side.
Daniel, I've got a question for you. We've seen some buyers very, very late in the game. I'm beyond contingencies, getting ready to close within a week of closing, get cold feet. And they've actually gone back to the seller and said, I'm just too concerned about this whole COVID thing, and I'm not willing to close at this point unless, you know, you give me an additional discount. If it's very, very late in the game and you guys are, well, pretty far along with the whole loan, how much is that going to affect your loan, and how much of a delay will that potentially give a buyer? I mean, I'm assuming you have to redo some things if I end up getting a discount, if a buyer ends up getting a discount.
Sure. Yeah. I mean, it all depends on where in the process that happens, right? Post docs or pre docs. But we have seen we've seen that scenario play out time and time again in the last few weeks. We've seen people go back, right before docs. We've seen people go right before funding and ask for some pretty what I'll call aggressive or outrageous credits. And the sellers, for the most part, I think I had one fallout, but for the most part, I had the seller grant the request or meet somewhere in the middle. And what we've been trying to do on the lending side is use that credit to the best of the borrower's ability to kind of hedge their concerns, which is one, the uncertainty with COVID and their payment. So we've been using it to buy down the rate. And so we'll, say, hey, look, you're going to get this big credit. Instead of using it as a price reduction, let's use it to lower your monthly interest rate, which is really at the end of the day what you're concerned with. So we have seen that play out quite a bit, and it just depends on where in the loan process it actually happens, to determine how much of a delay there is. But normally there isn't much of a delay. I mean, we haven't seen anybody say, hey, we're putting this on hold indefinitely. We haven't seen that yet. I mean, for the most part, buyer and seller have said, okay, we're going to, do this, or here's the plan of action moving forward. But we haven't seen anybody just say, hey, guys, we're just going to be in a holding pattern for an undetermined amount of time.
Yeah, maybe a day or two delay, Gus, max at that point. We've been able to add seller credits even before funding. So, on the loan side, it's not going to delay things drastically. We have the ability to get that file back into the underwriter's hands, right away in order to minimize the delay.
That's good to know, because our sellers, want to know, if I do this, how's that going to affect,
right,
our ability to close in a timely manner. So a couple of days is no big deal. I think we're going to see a lot more of that, because I think a lot of buyers, even the ones that are willing to close, are going to throw that out at the last minute just to see what they can get. So I think we're going to begin to see a lot more of that.
Well, and it's the build a case of, look, guys, to the seller, right? We're already at the finish line. Please give me this credit and I'll buy your house, you know?
And if they find the right day, you know, when maybe the market takes a drop or what have you, they can make a pretty good case, and a seller may think, how am I going to do with the next buyer? So we're finding that buyers are pretty much getting their discount at the last minute. And we're going to see a lot more. Winnicky.
Hey, this question's for Gus. Do you think that, well, obviously buyers are just leveraging, you know, that they've gained some leverage that they haven't had in the last 6 years or whatever it is. And they're just kind of smelling it and saying, hey, let's take a shot. We've got some leverage.
Yeah.
We'll just tell them, even if they have no intention of backing out or canceling, I feel like they ask, why not? Can't hurt.
100%. And let's be clear about this. This is agent driven, frankly. It's really not buyer driven. It's going to be mostly agent driven. And you know, every agent out there is trying to look like a hero in the eyes of their client. And they may say, hey, listen, at the last minute, we're going to ask for this and see what else we can get. So, you know, then agents talk in the office and somebody has some success doing that, and then everyone's going to do it. So I'm expecting a lot more of that for that reason.
Who's got an outrageous lowball offer story? Curious. Has that happened yet to anybody? Or is that next week's call? As things.
I actually had one. I had a property listed in the low 8s and got a, you know, of course, an investor, sight unseen. Hey, 675, you can represent me. So I advised my clients to take it.
How did you open escrow on that? For how much?
Yeah, I advised my clients to take it. I said it was a great deal.
Anybody else? I think we're going to probably start seeing that more and more as time goes on and as things continue to kind of slow down. And I think we're not really at the peak of the slowdown yet, but don't be surprised. I think, especially on the higher end, we may see, you know, some crazy offers on some higher end properties. But
I think it's important as agents, when you're representing sellers, to remember that a lot of people, like Daniel was saying, are going to throw out these lowball offers. Present them anyway. You know, first of all, you're obligated to present them, but you never know where they're going to go. You know, they may start really low. They may end up somewhere fair. So don't automatically, you know, disregard an offer just because you don't like the number.
Yeah. Awesome. Any other questions before we wrap up, guys? I know it's been an hour and I want to be respectful of everybody's time. Any other final questions, comments for the group before we wrap?
Daniel, I just want to chime in one quick thing. I was on a call yesterday similar to this, and we were interviewing an escrow officer, and she said she had 13 deals fall out that week, and every single deal went right back into escrow. So deals are not dying and stale. There's still plenty of appetite in this market. So it's good that I've been on multiple of these calls now, and the feeling is that the market still feels good. We're not, even though there's a couple of changes and buyer behavior and seller behavior is starting to change a little bit, the feeling is that the market is still resilient and good.
Awesome. Cool. Thanks for that, Gino. So we'll see you guys all next Tuesday. Just a reminder, we're doing these every Tuesday at 10:30. Next week, we're actually I'm going to try to get one of our local physicians from Huntington Hospital to jump on a call and give us a little COVID update. He's here local, so we're trying to work out scheduling, but please join us next Tuesday, 10:30. Have a blessed day, everybody. And thank you for joining. Have a good day.
Bye, everyone.
Thank you, Daniel.
Bye.